Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Greenland Hong Kong Holdings Limited interim report. Greenland Hong Kong Holdings Limited market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Greenland Hong Kong Holdings Limited trades at a lower price-to-book ratio of 0.06 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 85% of total assets. This elevated debt level warrants heightened caution, as it may limit financial flexibility and increase risk during economic stress. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Greenland Hong Kong Holdings Limited offers a diverse range of businesses and services across various sectors. At the core of its operations are property development and sales, as well as leasing commercial and residential properties to clients. The company also operates hotels and service apartments, catering to the needs of travelers and locals alike. In addition to these primary activities, Greenland Hong Kong Holdings Limited provides a wide array of related services. These include property management, construction and decoration, commercial management, and construction management. Furthermore, the company offers financing solutions, software development, nutrition and health counseling, business investment, management consulting, marketing, human resources, and advertising services. The company's extensive range of services also extends to information transmission, software and information technology, and hotel development. This comprehensive approach enables Greenland Hong Kong Holdings Limited to provide one-stop solutions for its clients' needs, making it a valuable partner in the industry. The stock price of Greenland Hong Kong Holdings has dropped significantly over the past year, with a reported decline of approximately -34.24%. Several key news events have contributed to this substantial decrease. One major factor is the company's challenging financial performance, particularly its significant revenue decline and increased losses in 2024. The company's audited consolidated financial results for 2024 showed a sharp drop in revenue from RMB 24,932,665 in 2023 to RMB 15,275,935 in 2024, leading to an increased loss before tax of RMB 1,599,004. Another significant event that likely impacted investor confidence is the material uncertainties regarding the company's ability to continue as a going concern. In its interim results announcement for the 6 months ended June 30, 2025, Greenland Hong Kong Holdings disclosed significant financial strain, including overdue loans and interest-bearing debts. This raised concerns about the company's long-term viability, leading to a considerable sell-off. The sustained decline in revenue generation over the past 5 years has also contributed to the erosion of investor confidence. The company's revenue has shrunk by 16% per year over this period, which is likely to have had a long-term impact on its stock performance. While the company reported positive sales updates for 2025, these were overshadowed by the more critical financial health concerns. Overall, the combination of these factors has led to the significant decline in Greenland Hong Kong Holdings stock price over the past year. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On the positive side, the company has experienced significant revenue growth due to several key factors. Firstly, an increase in total contracted sales by approximately 10% from the same period last year has contributed to revenue growth. Additionally, structural upgrades in core business segments have improved development efficiency and shortened product line iteration cycles. Furthermore, the company has seen a substantial increase in total GFA sold and delivered, with a 27% rise from last year. This is accompanied by an average selling price increase of 11% from last year. The company's continued innovation and breakthroughs to create high-quality products and services have also played a crucial role in driving revenue growth. Moreover, the implementation of policies has led to remarkable results in delivery, while the long-term leasing business has experienced revenue and profit growth. The mixed operation model enhances asset operation efficiency and profitability. The commercial operations dual driving force strategy of real estate plus commerce has driven growth, and the expansion of projects under management has accelerated. On the other hand, the company has faced a decline in revenue due to a decrease in hotel and related services revenue, as well as rental income decreased by 11.7% from RM127,952,000 in 1H 2024 to RM112,951,000 in 1H 2025. However, despite these challenges, the company's overall revenue growth rate remains at 10%, with a total revenue growth of plus 9.2%, 2025 versus 2024. Net income experienced a mixed trend over the period. Initially, it increased by approximately 9%, rising from RMB 6,330 million to RMB 6,936 million. However, in the subsequent half-year, net income declined by around 1%, dropping to RMB 500 million. The change in profit margins was more pronounced. While enhanced commercial value and satisfactory occupancy rates led to an expansion of profit margins for certain projects, a decrease in gross profit margin from 14% to 10% suggests that overall profitability may have been impacted by other factors. The company's debt level and interest expenses have undergone significant changes. On one hand, the total liabilities increased by RMB 4,616 million, which may seem counterintuitive given that total borrowings decreased by RMB 12,831 million. However, a closer look at the interest-bearing loans reveals a more nuanced picture. The initial decrease from RMB 14,487 million to approximately RMB 11,656 million suggests a reduction in debt. Nevertheless, an increase of RMB 264 million subsequent to the reporting period indicates that the company's debt level is still rising. Moreover, the interest expenses have also decreased significantly, dropping from RMB 465,058 to RMB 393,950. This decline may be attributed to various factors, including changes in interest rates or the company's ability to negotiate better loan terms. Overall, while the total liabilities and interest-bearing loans exhibit mixed signals, the decrease in interest expenses suggests that the company is making progress in managing its debt obligations. The company's core business segments and key regional projects have shown positive results, with the Asia region experiencing a notable revenue increase of 10% from last year. This indicates that certain areas of the business are performing well. However, not all segments have been as successful. The property segment has struggled to turn a profit, recording losses in both the first half of 2025 and 2024. Similarly, the hotel and management segment has also experienced significant losses over the same period. These underperforming segments will require attention from management to improve their financial standing. Management's outlook and strategy. The company's management team is optimistic about its future prospects, highlighting several key initiatives that will drive growth and success. One of the primary strategies is the establishment of innovative mechanisms to address industry challenges. This forward-thinking approach enables the company to stay ahead of the curve and adapt to changing market conditions. In addition to this proactive stance, management has emphasized the importance of focusing on key regional projects while embracing market changes. By concentrating on strategic areas and being responsive to shifting market dynamics, the company is well-positioned for long-term growth and sustainability. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, subsidiaries, or businesses that would be considered as major transactions. This suggests a stable and conservative approach to business operations, focusing on existing resources and capabilities rather than expanding through external means. The company's financial activities have been transparently disclosed. One notable aspect is the payment of dividends to its shareholders. In 2024, a dividend of RMB 43,521 was distributed at a rate of 10.21% applicable to perpetual securities for the current interim period. On the other hand, there has been no indication of share buybacks by the company. Despite an absence of information on this matter in page 46, it is explicitly stated that the company has not bought back shares on page 48. This clarity provides a clear understanding of the company's financial decisions regarding its capital structure and shareholder value. Concerns have been raised regarding inventory buildup in the company's operations. A significant issue arises from the use of inventory properties with a total carrying amount of RMB 13,983 million as collateral for overdue loans, page 37. This indicates that a substantial portion of the company's inventory is being utilized to secure debt obligations, potentially hindering its liquidity and financial flexibility. Furthermore, an inventory buildup has been noted on page 55. This suggests that the company may be experiencing difficulties in managing its inventory levels, which could lead to supply chain disruptions if not addressed promptly. The accumulation of excess inventory can result in wasted resources, reduced efficiency, and increased costs for the business. That concludes the financial summary for Greenland Hong Kong Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.